Good afternoon, everyone. My name is Emery Realbird. I'm in the Office of the Treasurer, Policy Advisor from the White Mountain Apache Tribe, and welcome to the webinar on the overview of elective pay and Native Hawaiian entities. Today we'll be joined with the Office of Tax Policy and the Office of Tribal and Native Affairs. And we're going to lead it off with a brief introduction by the Treasurer, Chief Lynn Malerba.
All right, so great Wikis. Greetings, everyone. My name is Chief Many Hearts, Lynn Malerba from the Mohegan Tribe. We're really proud and honored to host this webinar with you. This is the first time that tribes have been able to access monetized tax credits under the IRA. And we know it's a very complicated topic, and it's one that is of great interest to our tribes, though, and we want to make sure that everyone who wishes to avail themselves of that are able to do so. So we thank our team here today. Joining us, we have the Director of the Office of Tribal and Native Affairs, Fatima Abbas, who you will hear from. We have Emery Realbird, who is a policy advisor. We have Josh Jackson and Jim Colon, who are also policy advisors. And joining us is Garrett Langford, who is on his second day here, working in our Office of Tribal and Native Affairs. So we're very happy to host you today, and we look forward to the discussion. I thank Office of Tax Policy as well as the Office of IRA Implementation for joining us today. So I will turn it back to you, Emery.
Thank you, Chief. And after that, we'll have Fatima Abbas, and I'm going to start sharing slides.
Great. Thank you, Emery, and aloha to the Native Hawaiian community in attendance today. My name is Fatima Abbas, and I am the Director of the new Office of Tribal and Native Affairs at the Department of Treasury, where we work on both tribal and Native issues to increase access to federal funding, and including in our work is service to the Native Hawaiian community. So the IRA includes $720 million in direct set-asides to both tribes and Native entities, but one of the most important elements of the IRA is that it unlocks billions in financing for Native energy development through tax credits. And typically both governments and nonprofits are ineligible for tax credits because they don't have tax liability. What the IRA does, however, is it removes this barrier through a process known as elective pay, or it's also commonly called direct pay. And this historic provision allows non-taxable entities to receive a tax credit for a qualifying energy project. And that could range from installation of a microgrid to battery storage. So today our colleagues from the Office of Tax Policy will be covering these credits, and then we'll take brief questions and answers at the end. I'll turn it over to Seth Hanlon to begin with the Office of Tax Policy.
Thank you so much, Fatima. I'm Seth Hanlon. I'm Deputy Assistant Secretary for Tax and Climate Policy in the Office of Tax Policy here at Treasury. And I'm joined by four of my colleagues here in the Office of Tax Policy. We're going to go more into depth into some of the topics that we're covering today, including the rules around elective pay, the low-income communities bonus, the rules around transferability. But I'm going to start by just sort of giving an overview of the Inflation Reduction Act clean energy tax provisions in general before we dive a little deeper into some of those topics. So we have to start just by giving some disclaimers. We're going to go through and give an overview of certain IRA tax provisions, Inflation Reduction Act. It's for general informational purposes only. What we say is not itself tax guidance. Please refer to the actual tax guidance at irs.gov. We'll rely on some simplifications and generalizations to convey high-level points. But of course, please refer to the actual IRS guidance. And an important part is, Treasury and IRS will carefully consider feedback submitted during the public comment periods for proposed and temporary regulations before issuing final rules. And indeed, stakeholder feedback has been a very important part of this, the whole process of implementing the Inflation Reduction Act. Okay, so I'll start with the overview if we want to go to the next slide. So the Inflation Reduction Act, enacted in 2022, signed into law by President Biden, makes the largest investment in clean energy in U.S. history. And much of that investment is delivered, in fact, most of that investment is delivered via tax incentives. And as such, the Treasury Department, being responsible for administering the tax code, is proud to be playing a central role in implementing this historic legislation. IRA includes tax incentives for a broad range of activities that include building a clean energy economy, as well as certain cross-cutting provisions and bonuses that apply to multiple incentives. And then this presentation is going to focus on two credit monetization mechanisms enacted in IRA, elective pay, which is also known as direct pay. In fact, most people call it direct pay. Elective pay is the official name for it. So you'll hear us say elective pay, but most people say direct pay, and we're talking about the same thing, and transferability. Okay, so just the very broad overview. So IRA created or substantially modified 20 different clean energy related tax incentives. So those include production tax credits for things like clean energy generation, and also for manufacturing, production of clean fuels, investment tax credits for renewable energy property, clean energy generating property, also energy storage, credits for clean vehicles and clean vehicle infrastructure like charging stations, and also incentives for energy efficiency in commercial and residential buildings. Now, some of those credits, so those are the underlying 20 different credits, one deduction, but 20 different underlying tax incentives. And then, so some of those credits, including the main production tax credit and investment tax credit for renewable energy, are enhanced by certain bonus provisions, and there are 4 of them. So the first is the prevailing wage and apprenticeship rules that multiply the bonus by 5 times if certain rules for prevailing wage and apprenticeship are met. Although small projects and projects beginning before a certain time are not subject to those rules. Then projects located in energy communities are also eligible for an increase in the production and incentive and investment tax credits. Projects that use like steel, iron, and manufactured products in the building of facilities, if those components are made in the United States, are eligible for a bonus for using domestic content. And then lastly, there's the low-income communities bonus, which provides either a 10 or a 20 percentage point increase in the investment tax credit. So a very sizable increase for projects that are located in or serve low-income communities. And my colleague Anisha Stephen is going to discuss that further in a bit. But mostly today's focus is on the credit monetization provisions. And when we say credit monetization, we mean really the means of delivery of the credit incentives. And IRA created 2 credit monetization mechanisms, both of which are brand new. The first is elective pay or direct pay, which is, as Fatima had already said, allows tax-exempt organizations and governmental entities to claim 12 of the IRA credits as in the form of direct payments. And then transferability allows other taxpayers, including businesses or other taxpayers, to sell, if they've earned any one of the 11 different credits, they can essentially sell those credits to other taxpayers who can then use the credits against their tax liability. So like I mentioned, the truly groundbreaking part of elective pay is that it extends these tax incentives that were really only for businesses before to tax exempt and governmental entities. And so the first time they can get, if they earn, do the activity or make the investment that earns the tax credit, they can receive a payment equal to the full value of the tax credit in the form of a refund from the IRS. And one of the key things about elective pay is that it's a very different paradigm than like competitive grant or loan programs, where an applicant, maybe may qualify for a program, but because of the competitive process and limitations, they don't get an award. Elective pay allows entities to get their payment. It entitles them to a payment if they meet the requirements for both being eligible for elective pay and then the requirements for the underlying tax credit that they're claiming. And they do that, for the entities that are claiming elective pay don't normally owe federal income tax, and many don't file federal income tax returns. But by filing a return and making the elective pay election, they can receive tax-free cash payments from the IRS when they've earned those clean energy tax credits. We can go to the next slide. And then, so transferability is the other mechanism. So with transferability, an eligible taxpayer, and this is generally entities that are not eligible for elective pay, so businesses and certain other eligible entities, can transfer all or a portion of credits they've earned to unrelated third parties in exchange for cash. So it's essentially a sale of the tax credit, so that an entity, if they earn the tax credit but can't use it against their own tax liability, can sell it to somebody else. And we'll get into more detail on that as the presentation later in the presentation. We can go to the next slide. So as I mentioned, there are 12 credits under IRA that are eligible to be delivered to via elective pay to those entities that are eligible for elective pay. And then there are 11 that are eligible for transferability. And so I can go through them quickly. Sorry, can we go back to the last slide for a second? I'll go through them quickly. I won't go describe them in detail, but the first four are the main tax credits, the production and the investment tax credits for renewable energy generation. So investments in things like wind or solar or geothermal, or energy storage, batteries or other energy storage are generally the types of things that these tax credits can go towards. There's four of them because in 2025, there's kind of a transition from the existing production and investment tax credits to new, what's called technology neutral forms of those credits, but they're largely the same. And so the production tax credit is generally per unit of clean energy produced, and the investment tax credit is a percentage of the clean energy investment. And so those are the first four. And Anisha is going to talk about the low-income communities bonus, which is an important provision that enhances the investment tax credits, substantially enhances it. And then, so the other tax credits that are eligible are there's a tax credit for zero emission nuclear power plants, existing power plants. And then the next two certainly may be of interest are the tax credit for commercial clean vehicles. And that's a tax credit of up to $7,500 for light vehicles or passenger vehicles, and up to $40,000 for larger vehicles. And those larger vehicles could include, buses, electric buses, or vans, or other types of vehicles that are used in a used for a governmental purpose or in an organization's activities. And then that's per those dollar amounts are per vehicle. And then the terribly named alternative fuel vehicle refueling property credit is for things like investments in electric vehicle charging stations. And it's also a very, very important credit that can be up to $100,000 per unit of, unit of property. Okay, we can go to the next slide. Then there are fuels production credits, the clean fuel production credit, the clean hydrogen production credit, the credit for carbon oxide sequestration. And then there are two credits for, there's the advanced manufacturing production credit and the advanced energy project credit, which goes towards building manufacturing facilities or retrofitting manufacturing facilities. And then as I mentioned, there are bonuses that apply to certain of the credits. So the prevailing wage and apprentice applies to most of the credits. Domestic content, energy communities apply to both the production tax credit and the investment tax credit. And then the low-income communities bonus credit is an allocated credit that's quite a unique program that tops up the investment tax credit. We can go to the next slide, and we might be, yeah. So I think that so that brings us to the next topic, and so I'm going to introduce my my colleague Anisha Stephen, who's a senior advisor in the Office of Tax Policy, who's going to give a few more details about the low-income communities bonus program.
Thank you, Seth. We can go to the next slide. So the Low-Income Communities Bonus Credit Program is under Section 48(e) of the Internal Revenue Code. It increases the existing investment tax credit by 10 or 20 percentage points for qualified wind or solar facilities that are less than 5 megawatts and that receive an allocation. As Seth mentioned, this is an allocated bonus, and because of that, there are Treasury regulations and a revenue procedure found on the IRS website that detail all of the rules and processes for owners of qualified solar and wind facilities to apply for an allocation of capacity. DOE is our administrative partner on this. They have an application portal on their website where they accept applications for the program and review those applications and make recommendations to the Internal Revenue Service. Next slide. To be eligible for the program, an energy facility must be in one of 4 categories that qualify for either the 10 or the 20% tax credit bonus. Congress authorized 1.8 gigawatts of annual capacity each year, which we have divided for the 2024 program year amongst the 4 categories in the manner displayed on the screen. Plus, we had 325 megawatts of carried over capacity from the previous program year. So in total, there will be 800 megawatts reserved for projects that are located in low-income communities, 200 megawatts available for projects that are located on Indian lands. Indian land is defined in the Energy Policy Act of 1992 and is linked in our regulations. 224.8 megawatts is available for Category 3, which are facilities that are part of federally subsidized residential buildings. There's a list on in the final regulations and on the DOE website that has a list of the federally regulated housing programs that make a building eligible for this program. And then lastly, 900 megawatts is available for Category 4 for facilities where at least 50% of the financial benefits of the electricity produced go to households with incomes that are below the poverty line or below 80% of the area median gross income. Next slide. So there are, as I mentioned before, there are 2 pieces of guidance to best understand this program. the final regulations and the revenue procedure. These documents contain all of the information to determine program eligibility for each of the categories. The final regulations stay relevant to the program. The ones that we issued in 2023 are still the regulations for 2024. And we recently updated the revenue procedure to provide more clarity for documentation and application processes. As I mentioned, we are in the 2024 program year of the Low-Income Communities Bonus Credit Program, and we are currently accepting applications. They opened last week, and they will be open for an initial 30-day window where all applications are treated as having been accepted at the same time. And then we will continue to accept applications on a rolling basis. Next slide. So you'll notice in the regulations that to further our impact, we focus on people and places that are disproportionately affected by energy insecurity. We know that some parts of the country and some facility owners may need additional time to meet commercial readiness to put together competitive applications. So because of that, at least 50% of the program's capacity in every category is set aside for solar or wind facilities that meet additional selection criteria. That additional selection criteria is based on ownership or geography. For example, criteria based on facility ownership includes tribal enterprises, Alaska Native corporations, renewable energy cooperatives, qualified renewable energy companies, and a couple of others. So on this slide, we wanted to highlight a couple of the features in the regulations and revenue procedure that are specific to tribal and Native communities. As I mentioned, the additional selection criteria, so in 50% or more of every single category is set aside for projects that meet ownership or geographic criteria. For the ownership criteria, it includes tax-exempt entities, which applies to Indian tribes, their political subdivisions or instrumentalities, tribal enterprises, Alaska Native corporations, and then qualified renewable energy companies. It's very small on this screen, but if you actually read the regulations, one of the qualifications for that is at least 51% of the entity's equity interests are owned by a Native Hawaiian organization. I'd also like to point out in category 2, there's 200 megawatts available for projects on Indian land. And then in category 3, for projects that are part of a wide variety of housing programs that allows eligibility for the Low-Income Communities Bonus Credit. Next slide. So there's a lot of information besides the regulations and revenue procedure that we've put together to help applicants understand the program and put together competitive applications. If you go to the DOE webpage, which is energy.gov/diversity/low-income communities bonus credit program, it's on the screen and we can also send it out afterwards. There is an applicant checklist, a user guide for how to use the portal, a number of frequently asked questions, a mapping tool so you can see what exactly you qualify for in terms of being in a low-income community or other, and then again, that list of covered housing programs. So with that, I will hand it over to the next speaker. Thank you.
Hi, good afternoon. The next speaker is me, Amber McKenzie. I'm an attorney advisor in the Office of Tax Policy. I'm going to be talking about elective pay, which we already mentioned is a novel tax credit monetization mechanism that allows so-called applicable entities, which includes Hawaiian Native corporations, some of them to receive tax incentives as direct payments for the first time. And the final regulations, as noted here, were issued on March 5th. So this is an overview of what I'm going to talk about, these 4 areas. I think we can go to the next slide. Here we're talking about who is an applicable entity. So under the final rules, the following categories of entities are applicable entities. And as you can see here, the first bullet that's highlighted, it includes tax-exempt organizations, which the final regulations define as any organization described in sections 501 through 530 of the code that meets the requirements to be recognized as exempt from tax under those sections. I would note that under some of those code sections, for example, section 501c3, you must receive a determination letter from the IRS that you are described in such section. So if a Native Hawaiian organization does not already have a determination letter that it is described in section 501c3, but it thinks it qualifies and it wants to get a determination letter so that it can make an elective payment election, it can request one by filing a Form 1023 or a Form 1023-EZ with the IRS. As you can see at the bottom of the slide here, in general, only applicable entities, the bulleted ones on top, are eligible for elective pay. However, other taxpayers that are not applicable entities may elect to be treated as an applicable entity with respect to 3 of the tax credits, 3 of the 12 tax credits that Seth mentioned. And those 3 credits are carbon oxide sequestration, production of clean hydrogen, or advanced manufacturing. And in that case, they only can make the election for 5 years and other restrictions apply. This slide is important because it's a reminder that, consistent with the proposed rules, partnerships and S corporations are not considered to be applicable entities. And that means they're not eligible to make an elective pay election, even if all the partners or all the shareholders are applicable entities. So the only exception to this rule is that a partnership or S corporation can elect to be treated as an applicable entity and receive elective pay for the 3 credits I just mentioned. Partnerships and S corporations are, however, so-called eligible taxpayers, and thus they should be eligible to make a transfer election, which is something Sarah is going to talk about in just a minute. And in addition, an applicable entity may jointly own projects through an association that is properly elected out of Subchapter K, or a tenancy in common arrangement for federal income tax purposes. And if they do, the applicable entity can make an elective payment election with respect to its share of the applicable credits determined with respect to its share of the underlying applicable credit property. This is another thing Sarah will talk about in a minute. Simultaneously with these final regulations, we issued proposed regulations intended to allow partnerships with applicable entity partners additional flexibility to elect out of Subchapter K, and thus make the applicable entity eligible to make the elective pay election with respect to its share of the applicable credits determined with respect to its share of the underlying applicable credit property. Next slide, please. So this may not be relevant to Native Hawaiian organizations because if they're described in 501c3, they would have a filing requirement, but we just wanted to, because we got some questions from government entities that don't have a filing requirement, flag that there's a special rule in the final regulations allowing them to choose their taxable year. And there's an FAQ on the IRS website if this is of any interest to you. Next, I wanted to highlight a special rule in the proposed regulations that enables entities to combine grants and forgivable loans with tax credits without reducing the amount of investment-related tax credit. So for these 5 investment-related tax credits, and here we're talking about the 2 vehicle-related credits, 30C and 45W, and the 3 investment tax credits, 48, 48C, and 48E, the amount of the credit is a percentage of the basis in the property, or generally how much it costs to acquire it. So the general rule would be that a tax-free grant or forgivable loan would not be included in the property's basis, and thus it would reduce the amount of the tax credit. So we enacted a special rule in the elective pay regulations that states that if an investment-related credit property is funded by a tax-free grant or forgivable loan, then entities can get the same value of eligible tax credits as if it were funded with taxable funds. The only caveat is that if the tax-free grant or forgivable loan is given to you for the specific purpose of obtaining the property, what the regulations call restricted tax-exempt amounts, then the amount of the restricted tax-exempt amounts plus the applicable credit cannot exceed the cost of your investment. Next slide, please. So here we have an example where a qualifying Section 48 project cost $1 million, and the project would qualify for a 30% credit or $300,000. And we have 3 hypothetical grants from the Department of Energy that are given for the specific purpose of obtaining and installing the Section 48 property. So these particular grants are considered restricted tax-exempt amounts as defined in the final regulations. I'm going to go a little out of order here. So Grant C is a grant in the amount of $1 million. Because the grant equals the cost of the project, the credit is reduced to 0. So the entity gets the entire cost of the Section 48 project covered by tax-exempt federal funds, but it does not qualify for a federal tax credit on top of that. Grant A is a grant in the amount of $850. Because the grant and the credit exceeds the cost of the project, the credit is going to be reduced to $150,000. So again, the entity gets the entire $1 million of the Section 48 project covered by tax-exempt federal funds, but the amount of the federal tax credit is reduced, so the grant plus the credit does not exceed the amount of the amount of the cost of the Section 48 project. Grant B is a grant in the amount of $500,000. So here, because the grant and the credit does not exceed the cost of the project, the credit is not reduced. However, in this example, the entity needs to come up with $150,000 of funds that are not restricted tax-exempt amounts. We did get questions about what is not considered a tax-exempt amount, and the final regulations clarify that an amount that is not given for the specific purpose of purchasing, constructing, reconstructing, erecting, or otherwise acquiring an investment-related tax credit property is not considered a restricted tax-exempt amount. The amount has to be restricted to the purchase of that property. So, for example, the tax-exempt amount from the organization's general funds, that's an easy one. It's not a restricted tax-exempt amount. And second and thirdly, if you receive an amount that is not restricted to the purpose of acquiring an investment-related credit property and you could use it for other things, that is not considered a restricted tax-exempt amount. Last, as I mentioned, our hope is that you will claim and receive an elective payment. And how would you do that? So this slide goes through the steps. First, you would identify and pursue the qualifying project or activity. You should make sure you satisfy all of the eligibility requirements for the tax credit and any eligible bonus credits for a given tax year. For example, you generally need to place the project in service before making an elective payment election. And you also need to determine your tax year if you don't already know it. Second, you need to complete pre-filing registration with the IRS, and this is done in an electronic portal at irs.gov. And I'm going to get back into this later, but basically you will need to provide information about yourself, which applicable credits you intend to earn, and each eligible project or property that will contribute to the applicable credit, among other information. And upon completing this process, the IRS will provide you with a registration number for each applicable credit property. You'll need to provide that registration number on your annual tax return as part of making the elective payment election. Third, you must file your required annual tax return as defined in our regulations by the due date or extended due date and make a valid elective payment election on that return. And you must also properly complete and attach source credit forms in accordance with their instructions, which will require including supporting calculations and including the registration number or numbers you received during the pre-filing registration process. A valid election allows you to receive payment as a refund for the amount of the credit, or if you have tax liability, to offset that tax liability and receive a payment for any remaining amount. And here, the earliest date you can get your money is the due date of the return, but you have up until the extended due date to make the election. And then the last step down there was you receive payment. So this is the example timeline, the same information, just in a graphical view. And here we're going to assume we have a Native Hawaiian organization described in Section 501c3 that is a calendar year taxpayer. The organization would claim the credit by filing the Form 990T with the IRS. Because the organization is a calendar year taxpayer, its Form 990T is due May 15th. So what's happened here? The organization placed in its clean energy project into service in 2023. In late 2023 or early 2024, before the organization's Form 990T is due, the organization completes its pre-filing registration process with the IRS and it receives however many registration numbers it needs for its project. Then the organization files its Form 990T between May 15th, 2024, the due date, and up to November 15th, 2024, which is the extended due date. And on that return, the organization makes a valid elective payment election and provides all the required information, including the registration number or numbers. And then after the IRS processes the return, the IRS sends the organization a payment in the amount of the credit. And with that, I'll turn things over to Sarah.
Thanks, Amber. So I'm going to talk first about the proposed rules that were issued at the same time as the final elective payment regulations under Section 761A of the Internal Revenue Code that allow certain arrangements, including that include applicable entities, to elect out of partnership tax treatment. So let's go to the next slide, please. So this slide just depicts what Amber had already talked about during her presentation, which is that a partnership itself is not an applicable entity, except for the 3 credits that any taxpayer can claim elective pay with respect to. And those are 45X, 45B, and 45Q. Other than those 3 credits, though, partnerships are not applicable entities. And that is the case no matter how many tax-exempt entities or applicable entities are partners in the partnership. However, both the proposed regulations and the final regulations under Section 6417 permit an applicable entity that co-owns the property or the facility through a joint ownership arrangement that validly elects out of partnership tax treatment to make an elected payment election for the credits that are determined with respect to its share of the property or the facility. Next slide, please. So what does that mean? So this is the current statute under 761A, as well as the existing regulations under 761A. And really what we were getting at with respect to applicable, with respect to elected pay is number 2 on both of these, under both of these sections. And that is property that is jointly owned for the joint production, extraction, or use of the property, but not for the purpose of selling services or property produced or extracted with respect to the property. Those types of arrangements are eligible to elect out of partnership tax treatment. Let's go to the next slide, please. So following the issuance of the proposed regulations in June of 2023, stakeholders said, let us know that it is important that applicable entities be able to co-own and operate projects with other entities, but that the existing guidance under Section 761A on arrangements that can validly elect out of partnership tax treatment was limited, and it required updates to be effective. And specifically, stakeholders raised that certain facts and circumstances common to jointly owned and operated energy projects appeared to violate the existing 761A rules. Next slide, please. So in response to those comments, Treasury issued the Notice of Proposed Rulemaking. And what it does is it adds exceptions to the existing 761 election out requirements for co-ownership arrangements that are organized exclusively to produce electricity from their applicable credit property, from the co-owned property or the co-owned facility, and for which one or more of the applicable entity co-owners intend to claim elected pay. So what are those exceptions? The first one is that the renewable energy investment can be made through a non-corporate entity, for example, a limited liability company, rather than requiring direct ownership of the property or the facility by the co-owners. A couple slides back, when the slide that was depicting the existing 761 regulations, those current regulations require the co-owners to directly own the property for state law purposes. The exception that we provided in the Notice of Proposed Rulemaking would allow the co-owners to own the property or the facility through a state law entity, such as a limited liability company. We're hoping that by allowing co-owners to use an entity will open up additional possible financing structures, which is part of the comments we received with respect to that request. The second exception that the proposed rules do is that they modify certain of the joint marketing restrictions to provide that members of the organizations, that the co-owners, can delegate their authority to sell their shares of the property produced, which is here the electricity, for a period of more than 1 year to the same agent, provided that the delegation of authority cannot be for more than 1 year. Well, what does that mean? That means that co-owners to the property can both delegate their authority to sell electricity to a single agent, and that agent can then contract on their behalf with, for example, a utility to enter into a multi-year power purchase agreement. So in order to take advantage of the new rules under 761, the unincorporated organization, the co-ownership arrangement, must meet these 4 requirements. 1, the organization must be owned in full or in part by one or more applicable entities. 2, the organization's members must enter into a joint operating agreement with respect to the property or the facility in which they reserve the right to separately take in kind or dispose of their pro rata shares of the electricity produced. 3, the organization must, pursuant to its agreement, be organized exclusively to jointly produce electricity from its applicable credit property, and for which one or more applicable credits, those that are with respect to electricity generation, must be produced. Lastly, one or more of the applicable entity co-owners must make an elective payment election with respect to their share of the credits generated from their share of the property. Okay, next slide. So this is an example, I'm just looking at time. I think we have a second. So this is an example that goes through how the new rules would be applicable. T is an Indian tribal government and an applicable entity. T and Y own the applicable credit property through a limited liability company. And here the facts are that it's organized under T's tribal law that has not made an election to be treated as a corporation or an association for federal tax purposes. T and Y enter into a joint operating agreement in which they each reserve the right to separately take in kind or dispose of their pro rata shares of the electricity produced or any RECs produced as well. On January 1st of year 1, T and Y enter into delegation agreements with Q that delegate their authority to sell the electricity generated by their shares of the property. The term of the delegation agreements is 1 year. On June 1st of that year, their agent, Q, enters into a power purchase agreement with the utility on their behalf that commits them to sell electricity produced from the property, from their shares of the property, for a term of 15 years. And at the end of the day, on December 31st, their delegation agreements terminate. So I'm not going to go through the analysis, but what the facts show, what the analysis states is that this fact pattern is compliant with the 761 proposed regulations and would be permissible. Okay, next slide. So now I'm going to spend a couple minutes talking about the complement to elective pay, which is transferability. Seth walked a little bit through what transferability is. It is, as I said, it's a complement to elective pay. It allows taxpayers that are not eligible to claim elective pay to transfer eligible credits, so the same credits minus the charging station credit, to an unrelated taxpayer in exchange for cash. The first piece of what I'm going to talk about is who is eligible to do that. We can flip to the next slide. So an eligible taxpayer is, just as I stated, it's anyone that's not an applicable entity, and applicable entity would include, as Amber went through, a tax exempt entity. So, but if a tax exempt entity forms a partnership with anyone, that partnership itself, as we've stated, is not an applicable entity, and that partnership would be, however, an eligible taxpayer that could transfer credits under Section 6418 under the transferability statute. Any taxpayer, we've defined that as really any taxpayer that's subject to any federal tax, which would include employment tax or excise tax. It doesn't have to be necessarily subject to income tax. Next slide, please. So how does transferability work? Similar to elective pay, a transferor must register each property or facility for which it desires to transfer credits. Unlike elective pay, we now have two parties to the arrangement, the transferor and the transferee, and those parties must jointly execute what's referred to in the regulations as a transfer election statement and file that statement with their annual returns for the tax year in which the credit is transferred. Directly from the statute is that no further transfers are allowed by the transferee, meaning once the credit is transferred once to a transferee, it cannot be transferred again. Transferors can transfer all or a portion of a credit. So for example, if a property generates 100 credits, the transferor could transfer 50 of those credits. It could also transfer those 50 credits to an unlimited amount of transferees. However, it can't separately transfer any bonus amounts, meaning that if a credit is increased because of prevailing wages and then maybe increased again because it's in an energy community, the transferor can't separate out the energy communities or the prevailing wage piece and transfer those separately. It has to transfer a vertical slice of each of the bonus amounts. Next slide, please. The final regulations under 6418, which I should have mentioned were published in April, a little after the elective payment final regulations came out. They provide special rules for partnerships and S corporations, which may be relevant if folks that are otherwise an applicable entity partner with someone and the partnership itself is eligible for transferability. The final regulations include special rules for partnerships and S corporations. I'm not going to go through them all, but we have them included here for you as a reference. Last slide. The last piece I wanted to mention about transferability is that there are special rules with respect to what's called an excessive credit transfer, and there are special rules for recapture. An excessive credit transfer is effectively that a transferor transfers more credit than it had to transfer with respect to a specific property or a facility. And if it does that, the liability for any excess credit claimed by the transferee is generally on the transferee, unless the transferor kept some credits with respect to the property or the facility. The second piece is recapture. So certain credits, such as the investment tax credit, are subject to recapture if a later event causes some or more of the credit to be recaptured, meaning a disposition of the property. For example, recapture liability under transferability is transferred to the transferee, meaning the transferee becomes liable for recapture. And that's, those rules are in the final regulations, how that works. Okay, I think I'm done. I think that's it. Yep. And with that, I'm going to pass it back to Amber to talk a little bit about the pre-registration process.
Thanks, Sarah. Yeah, I'm back. So now we're going to come back to the process that both Sarah and I previously mentioned, the pre-filing registration process. So this is done in an electronic portal, Energy Credits Online. Congress authorized the required pre-filing registration process under both elective pay and transferability. And pre-filing registration is mandatory for applicable entities, electing taxpayers, or eligible taxpayers that wish to make an elective payment election for applicable credits or a transfer election for eligible credits. It is a critical tool for the IRS to safeguard against fraud and improper payments, as well as providing the IRS with basic information to help ensure filers are able to access credits more readily after they file a return to clean energy tax credits. So the regulations describe the manner of pre-filing registration, the pre-filing registration and election for members of a consolidated group, the timing of pre-filing registration, the requirement that each applicable credit property have its own registration number, and other information that is required prior to completing the pre-filing registration process. The portal also has helpful information, including video tutorials and publication 5884, also known as the user guide, both of which provide detailed information on how to register. And we are going to continue to monitor the pre-filing registration process to determine whether there are areas in which more efficiencies can be created. So this slide here has some screenshots of the portal. On the left, you could click the button for clean energy and semiconductor manufacturers. And on the right, you would click the 2023 IRS/CHIPS registration. Then you would go step by step in accordance with the user guide and the tutorial to register each of your energy properties and get each of your registration numbers. And more information about the step-by-step process can be found in the appendix. This last slide lists some of the places you can get more information. We tried to make this as user-friendly as possible. There are resources at both IRS and the White House, and you might want to keep this information in your back pocket if you wanted to refer to it later.